Markets have recovered from that big sell-off we saw in April, but what were the big lessons for investors, and do we have more volatility potentially ahead? Joining us now to discuss, Jing Roy, VP Director and Portfolio Manager for Asset Allocation with TD Asset Management. Jing, great to have you back on the show.
Thanks for having me.
I've said it a few times on the program that if you fell asleep for the entire month of April, and unfortunately I wasn't asleep, I was awake for all of it, but if you were asleep, you would have said, what was the big deal? What happened after Liberation Day? And now we're actually not that far from all-time highs. Well, what happened, and should we get ready for a little bit of a bumpy path?
28% at the effective level. It was much higher than what the market had expected. As a result of that, you see the S&P 500 index sell off by 20%. And that contagion of higher volatility from the equity market went into the fixed income market. As we know that there's a spasm in the US Treasuries. And those are the underlying foundational pipings of how risk assets globally being priced. As a result of that, there's a Trump pivot because of the gravity of the situation and what it means for the risky assets.
Would it be a mistake at this point to say, oh, well, that's behind us now, we don't have to worry about tariffs? Because the market seems to have shifted its concerns, right? Tariffs are front and center for good reason. And then we got a bit of a boost, and when China and the U.S. seem to be willing to talk about a little bit. And now we're seeing the bond yields react again. Now, different concerns, right, about the U.S. government spending.
So things are definitely looking better than what happened on April 2nd. But the volatility will continue because there's a step change in how the policy making process and procedures are done at the executive branch in the U.S. So we see volatility remain elevated. Right now it's back to historical average of 18%, but it could be higher for three reasons. First of all, we see higher yields. As we know that U.S. Treasury is considered a risk-free asset, and the yield on a risk-free asset goes up, and that means the required return on risky asset will go up globally as well. That means that investors will pay less upfront for those risky assets and cause the price to go down. That's a major concern, and yields will stay high because the one big beautiful act is causing the fiscal sustainability of the U.S. government to be caused into question. So the fiscal deficit will be estimated to grow at over 3 trillion, close to 4 trillion over 10 years. So that means, debt is increasing at the annual rate about, let's say, a little over 1%. But the GDP benefit from that tax cut is only 0.6%, 0.7%. So the multiplier from that tax cut is not large enough for you to, close the fiscal gap. So that's one reason why, the U.S. Treasury yield is continuing under kind of pressure. The second reason is that, when you stop trading with your trading partners, we have to understand in the U.S., the biggest foreign buyer of U.S. Treasury debt is actually countries with the biggest current account surplus. That's China, that's Japan. Those are the countries you stop trading and start charging the tariff on, then, there's less capital being recycled back into the United States to purchase the Treasury. And because of the policy uncertainty in the U.S. has been, very, very elevated. As a result of that, U.S. dollar is weakening. So for these foreign central bank reserve managers or investors to buy U.S. assets, they now have to worry about a weakening dollar. As a result of that, you have to hedge the dollar, and the attractiveness of the U.S. Treasury bill after hedging for the currency is, materially deteriorated. So there's less foreign buying for the U.S. Treasury bills. As a result of that, there's upward pressure on U.S. Treasury yields.
Some have opined that was the real reason that we saw a softening of tariffs out of the White House because of what the bond market was up to. It wasn't the equity market, it was the bond market. So when it comes to those tariff negotiations, what are you seeing right now?
The tariff negotiation is going better than I thought would be because the swift deal with the Chinese government. But it's just kicking the can down the road in 90 days, in early July, in early August. All these 90-day kind of reprieve will start to expire. And we know the negotiation with Japanese government and Koreans and the European government isn't going, it's tough slugging. It's not as easy as people think. As a result of that, there's significant chance of escalation in tariff threats within or after the 90-day reprieve. So right now, the effective tariff rate is about 18% based on the higher end of the estimate. What that means is it's reducing the GDP growth by about 0.6%. So in a kind of coincidental way, that's basically being offset by the big, large fiscal package being tabled in the House right now. So net, you'll have zero, kind of neutral impact on the GDP growth. But under the current, the underlying sector, there's winners and losers. The tax cut actually is very regressive. The wealthier household actually are beneficiaries of the tax cut versus lower income households. So, but they're more affected by the tariff price inflation. So we have to take a look at how these lower income households and small medium business can weather this tariff storm.
Now, when I was growing up, if I ever got in trouble, my dad wasn't a yeller. He'd always just give me a long talk and say, as long as you learned something, my son, as long as you learned something. Did we learn anything from April, from all that volatility and that round trip on the S&P 500 and some of the other indices?
Never let a crisis go wasted, right? So I see 3 lessons for us investors. First of all, taking risk is really the price we pay for harvesting a return from the equity market. And it's nice to have a base rate. Over the very, very long term, the average volatility of the S&P 500 index is actually 18%. What does that mean? It means there's a very high risk that your portfolio will draw down 18% in any given year. So as we saw, in April, we draw down 20%. So that's nothing out of the norm. If an investor has a full, 100% allocation to U.S. equities, and you're uncomfortable with the 18% drawdown, you should reassess whether that asset allocation actually fits your risk appetite and your financial goals. That's lesson number 1. Especially, the market is coming back to within 1% of the highs. It's time to reassess. Not too late. There's no permanent damage done.
Portfolio construction, that's what it sounds like there. Some people think the 60-40 rule might not apply anymore. If you're thinking about portfolio construction, maybe you're over-allocated in U.S. equities. What do you need to keep in mind? Is 60-40 still working? 60-40
can work very well in environments where growth is dominant concern for investors. But in this environment, as we know, inflation is the dominant concern. So here, the bonds will actually do less well to offset the decline in the equities. Sure, they can still provide a stable stream of income, but it might not keep up with the inflation, and it will not offset the amount of drawdown in the equity market because central banks are more constrained. When inflations are high, they will not be able to cut rate as aggressively to kind of put a bottom in the economy to help with the employment situation. So as a result of that, you want extra diversification in your portfolio to help you weather that.